Welcome to Building Wealthy Habits podcast. Now, this features content and conversations with me, Randy Barkley, Jeremiah Lee, along with Laura Lee. On this podcast, we share financial advice from a team of certified financial planners, including a California licensed attorney, an MBA professional with collective experience of over 40 years.
Today, on this episode of Building Wealthy Habits, we are talking with an investment expert. Dr. Jason Thomas from Portfolio Design Labs joins Randy and myself to talk about investing. We take a look back at the history of investing. We take a look back at or where we are now and where we're heading. So we hope you enjoy this week's episode. Goodness for women's basketball.
Thank goodness for women's basketball has renewed my faith and interest in college sports.
Okay.
You know, the stories, there's a little bit of the gimmicky professional, the deals. I don't love necessarily that aspect of it, but the stories, the kids are staying in school longer. They're kids.
Yeah.
That's what you got to love about college.
They're enjoying the game, right? Yeah.
That's right. And
the refreshing aspect of watching Caitlin Clark and some of the other women basketball players. I mean, talk about intimidating. That woman can hit it. I mean, she's at the 3-point line and she's boom, boom, boom. I mean, it's
amazing.
Like, get out of the way, right?
So I'm not as into women's college basketball, but I will say I recently got a chance to preview the documentary of Sue Bird. And it obviously is a recap of her life and her career and what it meant to be an aspiring female athlete. Very well done. So keep an eye out for it. It's called Sue Bird in the Clutch. And I actually just shared it with my 11-year-old daughter. She has a good friend of hers that is hands down loves basketball. That's all she wants to do. Eat, sleep, play basketball. So I said, hey, you got to check out this documentary. We all need something to aspire to, right?
For sure.
Absolutely. All right. Well, let's dive in. So in this series, we've been going through a few different episodes where we've been taking a look back at various aspects of our industry and a look at where we are and maybe even some insight into where we're headed. But today we've got a special topic and a special guest. Today we're going to talk about investing. And for this conversation, we wanted to bring in a topic expert. So I'd like to introduce our guests and our listeners on today's show to Dr. Jason Thomas. And I'm going to read this bio because I don't want to miss any of these details. It is so impressive. So Jason is the Chief Executive Officer of Portfolio Design Labs and a recognized expert in risk management and investment management. He has been widely quoted in the Wall Street Journal, New York Times, Financial Advisor, and other industry publications, as well as has appeared on CNBC. Prior to founding Portfolio Labs, Dr. Thomas was Chief Investment Officer of AssetMark, the leading asset management platform for financial advisors with AUM over $80 billion. And there's more that can be said, but for right now, I'm going to pause. And Jason, we just want to give you a warm welcome to Building Wealthy Habits. We're so excited to have you.
Welcome, Jason.
So much. Thank you so much. It's really a pleasure to be here. Can't wait to have this great conversation.
Good.
So to kick us off, we're going to have kind of a casual Q&A and really just pick your brain. So a great time to just gain some of your insights. So we want to have a conversation about investing where we take a quick look back. And we want to spend the bulk of our time on where investing is now and where it's headed. So to get us started, Jason, can you give us, this is going to be hard, a brief history of what investing looked like in the U.S.?
Yeah, over history. So we've had now, globally, I'd say about 450 years to get where we are. And I would say that the two really big events, the milestones that got us to where we are today, number one was the invention of the corporation.
Interesting.
You go back to 1600, the East India Company, and this idea that there could be a business that was distinct from the individuals that participated in the business or even owned it. You could have multiple owners that financed the business that actually had nothing to do with running the business at all. Right? They were just the money people. And that concept was so important to the aggregation of capital that was necessary ultimately through the Industrial Revolution, which required a lot of capital, and to the markets that we see today. And so that number one important thing was this idea of this ongoing business, what we would call a corporation. And the second thing that was critical was, of course, the invention of a public market. And they talk about Willow Street, which was where commodities were traded. But the opportunity to take this ownership stake, corporation, and sell it to somebody that you don't know for a price that everyone can see, and to buy it back later that same day if you want, and to have that be recorded, and to just be able to do that using technology at an ever decreasing cost, is, when you combine it with the invention of the corporation, has brought us to where we are today, which, in my opinion, is the most exciting time in the history of human beings when it comes to being able to invest and grow wealth.
Now, I don't know, you probably do, but when we had to compare timeline when the U.S. was establishing its public market, how many other countries had an established public market? You know, were there several, or were we one of the first ones?
There were several. I mean, Europe is so far ahead of us in terms of time in so many ways. And commodities were, of course, the first thing. The East India Company was really all about finding and extracting commodities around the world. But what is special about the United States, and what really developed for us in the early 1900s, was the preference for having large-scale economic activity taking place in these companies that were publicly owned. You know, it is still the case that as you go around the world, lots of the very biggest companies are family-owned. Now, in the last 20, 30 years, some of that has changed, and some of the big European companies have been bought, or at least portions of them have been bought and floated on the public markets. But it used to be in so many other economies, you could not access the very best companies that you would be a part of. Well, as in the United States, almost all, something like 90+% of the economic activity that's taking place is available for you to participate in through public markets.
Wow.
And that's really
we're talking thousands and thousands of companies now that participate in the public markets, right? All across the world.
Oh yeah, right. I mean, across the world, there's probably bordering on 10,000 companies,
right?
That you can invest in, participate in, and yet not have the liability. I mean, again, these things work. The corporation and the public markets, those two concepts work so well together. And then when you look at what's happened with technology, which has allowed companies like Fidelity, Schwab, to offer you the opportunity to do that at zero cost.
That to me is probably the biggest event over the last 5 years to 10 years. It's just as the cost of transactions have been driven down to zero. One of the people that I've read a lot about, of course, is John Bogle, and just the father of almost the index funds. I'm not sure if he was the originator of it, but it sure blossomed under his authority and under his management. But of course, one of the values of an index fund was that it was very low cost, and you could get spread out. That's really been challenged now going forward, hasn't it?
Challenged in terms of whether index funds are the right way to invest, you mean?
No, cost. I mean, you can participate in a large number of stocks and create your own index, so to speak, without having to give money to a management company into what I'm saying.
That's right. So the expense of doing something other than investing in an index fund has come down a lot, right? So there's, and I think what that shows is that only part of the benefit of an index fund originally was the low cost and the low taxes, the low turnover. What really is special about an index fund is that it benefits from the wisdom of the crowd. right? It's the holdings and the weights that over time you realize, it's really hard to beat that. There's a lot of wisdom there. And, you can see that even though lots of other kinds of strategies, new vehicles like exchange traded funds have come along and also tried a low cost approach, they're not nearly as good or as successful commercially because they don't have that wisdom of the crowds aspect. And that was really critical.
An efficient means of diversification. So
absolutely. That's right.
Is the wisdom of the crowd kind of open that up a little bit more for our listening audience, Jason? The wisdom of the crowd, is it something that we can harness, or is it something that takes us down a road of demise, I guess is what I'm saying? Is the crowd always right?
The crowd is not always right, but the crowd is always wise. Maybe I'll say it that way.
Interesting.
There is a lot of information in the prices that we see. And that is the result of lots of people with different sorts of information and, beyond the scope of this call, but there's a lot of wisdom that gets embedded in the prices over time. And what that means is we can confidently take those prices as a starting point, right? So if one share of Apple, formerly known as Apple Computer, but one share of Apple, is selling for $168 today, we can be pretty darn sure it's not worth $50 and it's not worth $350, right? In terms of the benefits that we receive as a shareholder into the future.
I love that. And you're naturally bringing, I didn't mean to cut you off. Go ahead.
No, I was going to move on to, okay, but where does it fall short?
Yeah.
Right. I was going to say, is there efficiency? Is there always efficiencies, or are there inefficiencies that we can take advantage of, or that you can take advantage of today?
Well, so there are absolutely inefficiencies, and the analogy that I give to lots of investors is, you can walk into a restaurant, let's call it a fast food place with good food, right? And you can order the value meal, and you can get a pretty good meal. It's something that likely looks the way you think a meal is supposed to look. It's going to have a main course and the side and the drink. And you can get that. And really the same thing at a restaurant. And you can get that without thinking very much about it. And oftentimes it's cheaper than trying to buy the individual components, right? And so that's a perfect strategy for everyone, right? There's a lot of strategies that are worse than simply relying on the wisdom of the crowds. But if there's anything unusual about you, there's something that you want to accomplish, there's some reason that you need something that's a bit different, then you can do better. And so if you're a bodybuilder and you're training for your next competition, that value meal is not going to be the right one for you. If you are, let's say, already retired and you're drawing from your portfolio and you'd like more income, more dividend yield, and a lower set of volatility, then the market portfolio may not be the right one for you. Not even necessarily because the crowd is wrong, but they just don't have, on average, the same preferences and goals that you do.
I love that.
That's really where the financial advisor comes in.
Yeah, I love that illustration.
Yeah, they don't have your best interests. I mean, the crowd doesn't care if you're 55 or 75, right?
Right.
That's right.
And so I love this because it brings this conversation to the present of where we are now, or at least our most recent history. And I had dove into some trends that we saw as a result of the pandemic. And really interesting. I mean, there are more people investing right from their smartphone on a daily basis. It's so very accessible. And this was a pivotal moment. I think it's leaving an impact on the trend that we see in investing. So some of the research that I found was TD Ameritrade at the time during COVID reported new account openings for its automated investing platform jumped 150% during COVID. On average, an individual was utilizing 3 or 4 or more apps to manage their accounts and investments online. So a common question that we get in our industry, in the financial services industry, is, well, are those robo-advisors a threat to what you do. So I love the illustration that you brought out, Jason, because sure, there's a value meal. There's index funds. There's something that might be broadly appealing to the general demographic. But if you find yourself unusual, needing some customization, special, then that value meal isn't going to serve you best. And that's where you might need some expert advice. But do you want to comment at all, just kind of in results of where we are now, kind of post-pandemic, and maybe some impact that you saw there?
The trends are fascinating. And I would say that coming out of the pandemic, during it and after, there are two things that I saw that concern me, and one that's I find very exciting. The first thing reminded me very much of the .com era. Mm-hmm. And you find when small companies that are exciting and innovative are the ones that are leading the market, it draws lots of people in to be speculative. And with the with the stimulus checks, which was not it's even amplified versus the .com era, where people now had a couple $1,000s maybe that they never would have saved, mm-hmm. and now go into the market, and these small companies, a lot of them stay-at-home tech type companies, were just skyrocketing, and that can bring people in and get them interested, but the downside is very speculative. Robinhood had some great numbers about how frequently their members checked the price of their stocks throughout the day. And if you're checking more than once a week, not to say 50 or 60 times a day, then that's going to be pretty speculative.
Yeah.
So that's one thing that had me worried, and I don't think we've completely worked that out. Mm-hmm. I think the second thing is when the broad indexes do very well, and we've had a period of time that's been very extreme in that regard, because the very largest companies were the ones really in the past couple of years that have done extremely well. When that's the case, then people stop thinking about what is what are their own, what they need, and they start thinking, oh, it's easy, I'm just going to invest in these indices, and lately even using options to magnify their bets, right? Mm-hmm. And so that's I get worried when I see that being the case, because again, the indices are great value meals, but nobody created the S&P 500 to have to be an ideal stock portfolio. It just kind of worked out that way. It's pretty good. It's not the best. Mm-hmm. Mm-hmm. What I love about what's happening right now is that people are beginning to look at their portfolios as an extension of themselves. And it really started with the values-based portfolios. We used to talk about SRI, which was socially responsible. It sort of morphed into ESG, which stands for environmental, and social factors. And I think it is, whether or not you have an investor has preferences along those lines, what it does is it makes it real and it brings it close. Investing in an index fund, it can feel so abstract to people, and it kind of makes it feel like it's gambling. Mm-hmm. I want people to think of their portfolio as a family business. Mm. And we have a communication I know you've shared with some of your clients called the New Family Business. Right. And it just talks about how these ownership shares in these businesses are a business. And when you're an owner, even if it's of the 500-ish companies in the S&P 500, you have employees, you have revenues, you have sales, you have innovation, right? You are an owner of a very small slice, a millionth or 100 millionth of these large companies. But it really is your company and your legacy. And there's every reason to take ownership of it and want to make it reflect your goals and your values.
Sure. It's another way to have a broad impact on the world that we live in, socially, environmentally, et cetera, because you're utilizing your purchasing power essentially to support various businesses. It makes me excited too. And I think that there's a lot of academics that are talking about the impact that the preferences and how that's going to impact financial behavior and investment behavior. And we might see some anomalies in the basic formulas that we've used before in terms of where we see trends headed. But ultimately, I think if that investor is driving excitement into the market, we're going to see more energy. And that overall, I think, is indicative of where we're headed, maybe.
Absolutely.
So again, I think one of the things that is kind of interesting to me is what we refer to as direct indexing. And I think it's going to be more of a trend. And can you kind of comment on that, Jason? Kind of what do you see as far as investment portfolio structure?
Sure. Direct indexing is all about the vehicle that you use to get access. It's about looking at an index, let's just say the S&P 500, very broad-based index, and instead of investing in a vehicle, a mutual fund or something that would give you access to that, it's using the underlying securities. And technology has given us the opportunity to invest directly in the underlying stocks, let's say of the S&P 500. And there's a whole lot of beneficial things that happen, tax opportunities, other strategies that are available. And this general strategy of having a very broad-based equity portfolio in an attempt to kind of match an index, but maybe do some other things that are beneficial, this has been around for a long time. It really started in the 80s, and it has kind of captured attention again in part because the indices have done so well relative to active strategies. Mm-hmm. But whether the ultimate goal is to have a very broad-based portfolio, hundreds of companies, or a more kind of finely tuned portfolio that's intended to either have lower risk or higher dividend yield or whatever it is, the same benefits that folks point to about direct indexing, especially on the tax side, those are available to other kinds of strategies. What is critical, though, is using individual securities as opposed to a commingled vehicle like a mutual fund.
Right. Let's talk about that. What's critical about the individual equities versus the mutual funds?
Sure. Well, the number one thing is taxes, mm-hmm. Right? The tax impact of investing in a mutual fund is worth understanding and is kind of beyond the scope here, but it is not. The tax you pay at the end of the year is not related to the individual securities that were held in that mutual fund at the time you bought in, mm-hmm. Right? You're buying into also a commingled set of tax consequences. Whereas if you buy the underlying securities, your tax consequences are determined by what you do with those securities. Mm-hmm. And so that gives us a chance to hold on to securities longer, to move from short-term to long-term, for example, to sell certain securities temporarily if they happen to have gone down in price, as all stocks do from time to time, to realize a loss intentionally. And so there are all sorts of things that we can do on the tax side, in addition to being very precise about the exposures, the nature of the company, this family business that you're building. Mm-hmm. And so if we want to try and increase the dividend yield without moving the portfolio to these, slower growing and more mature companies, right? If you just buy a commingled fund that's high dividend, you will not only get high dividends, you will get much slower growth. You'll get an entirely different relationship to the economy than you would with the S&P 500. And with individual securities, we can mitigate that and really dial in exactly what it is that the financial advisor that you design for the client.
And again, just to kind of come alongside of that, I mean, what's made this that we're able to do this, or what you're able to do now, is the cost of transactions. Cost of transactions have gone to zero. And just a few years ago, the kind of trading that it kind of handcuffed you, because you'd have to look at the transaction costs in light of what you're trying to accomplish. But now that the transaction costs have gone to zero, and I emphasize that to clients, I said, we literally pay nothing for trading your account. And they kind of look at me startled, because they still have the old mindset that you got to pay a a commission or some kind of transaction cost to buy and sell something. I said, that's what makes it more fluid now, is because we can do that. And people like yourself, Jason, you can step in and you don't have to worry about that. That's not an issue of concern for you, is it?
That's right. That's 100% right. Mm-hmm. And when you combine that with the relatively low, compared to history, capital gains rates and opportunity for qualified dividend rates, it gives us much more flexibility in managing the portfolio. And I think sometimes, nobody wants to pay taxes if they don't have to, but I think sometimes clients are a little bit too reluctant to pay taxes to adjust the portfolio, particularly long-term gains. And just to help with that conversation, we've got a calculator. We've got a piece that shows, okay, when should you take gains and when shouldn't you? And that's a terrific conversation to have, because as you say, the new capabilities, the lower cost, the technology tools that we have allow us to be very effective in building portfolios.
I love that. It's the magic of tax loss harvesting built on this strategy behind holding individual equities within the portfolio, as well as the, like you said, Dad, almost nominal to zero cost of transactions. So Jason, you're such a wealth of knowledge. In our last minute here, I just want to give you some space. If there is, if you had to debunk a myth or more than one that you hear all the time about investing, what's the main myth that you would want to debunk?
So many.
That's why we'll have to have you back. So just more.
Just on that, but the number one thing I would say in terms of impact is that I think many investors have rightly understood the dangers of some of the more sophisticated tools that we use. Selling a stock short, for example, which means selling a stock that you don't own yet, and then in the future having to buy it back with the expectation that you can buy it back for a lower price. And so you can, that's if you think the price of a stock is going to go down, or if you're afraid it's going to go down, right? Using options. I mentioned earlier that many individual investors are using options to speculate. They're using options to increase their purchasing power beyond what they otherwise would, right? And so those tools can be used, and they can cause problems in portfolios, but they can also be used in a very professional way to limit risk, right? To reduce exposure, let's say, in a certain part of the market where we don't want to have that exposure, or to sell options as a way of selling part of the upside of a portfolio in return for some capital, some income now. And so I encourage people to understand, or at least be open to the idea that some of these tools in the hands of professionals can actually be very helpful and far outweigh whatever the cost in terms of fees or the costs in terms of taxes, far outweigh those costs over time.
Well, thank you. I feel like we could keep talking for multiple episodes. So hopefully you'll come back and visit us again. This was really, really helpful and beneficial. I hope our listeners enjoyed it as well. So thank you again, Jason, for visiting Building Wealthy Habits today.
Thanks so much. Always a blast to talk to you guys, and would love to get an invitation back.
Until next week, folks, may you grow in wisdom and knowledge. Thank you for listening.
We have a few more things to let you know about before we go. Podcast reviews really help us to serve more people and get this information into the hands of the people who need it. Please leave us a review. Even if it's not 5 stars, we welcome the feedback.
And we invite you to let us know what topics you would like to hear more about, or what would benefit the people in your life who you're closest to. We have more resources online. Those resources are designed to help you share this great information easily with people in your life. To access those resources, please visit tricordatvisors.com.
Often we hear from clients that they wish they had talked to us sooner. If that's you, we'd be thrilled to see how financial planning can benefit your life. Email us at contact@tricordatvisors.com or simply click on the link in the show notes.
This show was produced by Graham Gardner at Model FA. Find out more about how to create a podcast for your financial planning business by visiting modelfa.com. We love creating content that's useful, resourceful, and maybe even a little entertaining. We want to make this mega universe of financial topics and advice applicable and helpful to your life.
Remember, at Tricord Advisors, we are your future's best ally.